Welcome back to 7-Minute Options. I want to take a bit of a closer look at earnings trades, how to find them, what to do, what not to do, what are good earnings trades, what are not so good ones. So earlier today, we opened up Best Buy. They are reporting earnings tomorrow morning before the opening bell. So we sold the 109 put, also sold the 125, 126 call spread, and right now it's trading for 116.96. And so we are hoping to collect roughly 50 or 60% of this 126 credit that we received. And right now I already have a good to close order to buy this back at 50 cents. Hopefully it goes my way. If it doesn't, actually there's 9 days for this to go my way. So we'll find out tomorrow morning which way the stock spikes. And then hopefully over the next 3, 4, 5 days, it'll come back toward this range that I chose here. Okay, so that's Best Buy, but there's a whole bunch of other stocks out there that are reporting earnings. So why did we choose Best Buy and not some other ones? So let's take a look at, for example, CRM, right? This is Salesforce. They are also reporting earnings. If I look at the trade here, on the surface, this looks like a great trade, right? They are reporting tomorrow after the bell. And we got the same weekly options expiration dates. So we got one 2 days away, 9 days away. As we discussed on the previous episode, you want to choose the one that's 9 days away. You want to give yourself enough time for the trade to go your way. And you can see there's good volatility crush happening here as well. 89% volatility here, the one that's expiring in 2 days. And then you can see the volatility drop. And so these options here are expected to drop to the same level as these ones. So these should be trading for about 35, 37 vol 3-4 days after earnings, right? So if you were to open a position here in the nine days to go, the June 4th expiration, the volatility here should drop from 55 down to 35. If I look at the graph on CRM, the volatility is pretty high right now. It might be a good time to sell one, but the reason why I didn't is because it's a very expensive stock. So if I want to do the same trick as I did in Best Buy, right, where I move just outside the expected range, like right around the 20 or 17 delta. In this case, let's look at the 21 delta, because that is, I can get $200 for it. Then over here, these are not $1 increments, right? The strikes are in $2.50 increments. And even then, like these odd shaped ones, odd priced strikes here, they don't have a lot of people in them. So you want to stick to the ones that are nice round numbers like 240, 245, 250, etc. But the best thing I can do here is to go for a, say, 245, 250 spread, which is $5 wide. So then I am holding risk to the upside. And even if I go to this $2.50 spread, I'm still holding risk to the upside, right? I can only collect $237 in premium. So there is like $10 or $13 of risk to the upside. Not a whole lot, actually. It's not that bad of a trade. But there's another reason why I didn't do it. And that's because the stock is priced so high and it is a bit of a volatile stock. Look, I would need $3,500 of buying power to maintain this position. And if Salesforce has a bad earnings report or a report that's worse than expected and the stock price starts dropping, remember, I don't have a defined risk on this side, which means as the stock price moves down closer and closer to this short strike, this buying power is dynamic. It will increase. For defined risk trades, it never increases. That, the risk is the $2.50 I have on the upside. That will never increase. But on the downside, the deeper the stock goes, the more and more buying power. So this could easily rise to $4,000 or $4,500 buying power if the stock were to drop down to 210. And the other thing to consider is the percentage drop, right? From 227 all the way down to 220. That's like a 10-point move on a $220 stock. That's like 5%. And a stock can easily move 5% on an earnings announcement. So for that reason, I don't want to keep this. I didn't want to open up one on this one. And many of the other stocks that look great because, they have high volatility. So if I look at this, here are all the earnings that are coming up. Let's say you want to pick one that's on May 28. That's great. And you look at it, okay, $140 stock, 29 IVR. So that might be a good one. If I take a look at it, there's no weeklies. So the closest one is 23 days away. There's no volatility drop whatsoever. That's not a good one. What's another one? DLTR, 57 IVR. That might be rich with 108. So they're reporting tomorrow morning. So I missed that one. But if I open up the weeklies here, you can see, look, there's nobody in these ones, right? These these markets are $7 and oh my God, more than $2 wide. There's not a soul trading these options. So I don't have a legitimate expectation that I can sell these back, right? At 80, between 89 and 148, maybe somebody's going to pay me $1.20 for these as I sell it. But if I want to buy it back, I can easily lose 10, 20, 30 cents on just the arbitrage when I try to buy it back from somebody to close the position. And if I can't do that, then now I'm running the risk of holding this through expiration, and it might get assigned to me if the stock is below, because again, I'm not going to have an easy time rolling this either if the stock drops below that. So basically, if there's nobody in it and the markets are very wide, don't touch it. Again, you're not going to be able to trade very effectively there. And so you just kind of go through that list, and you want to try and find like a half decent company like Best Buy. Again, this is a $30 billion company. This is not a meme stock like GameStop that's just going to go like crazy and you'll never see your money ever again. And that's going to destroy your account in any way, whether it's moving up or down. And because it's a real company, I don't expect it to drop down to like 85 or 90 and stay there for 3 months. I don't, because there isn't going to be that much of a surprise with Best Buy. I mean, look, there's always the chance that, like the CEO gets arrested for fraud or something that you just can't foresee. But even then, Best Buy would survive it because it's a big enough company. That's why I feel comfortable having an undefined risk position on the downside. Now, you might be asking, why don't I do the same thing on the upside? Why don't I have an undefined risk on the upside and just sell a strangle? I don't like selling strangles in stocks on earnings plays, because if the stock goes very, very high, there's a chance it might never come down. So then I would be rolling and chasing a stock that goes further and further away, and you don't want to do that. That can be very, very stressful, because there's a chance the stock is going to take off and will never, ever come back. I mean, look at somebody who sold a strangle in Tesla when it was like $400. They could be waiting for the next 2 years for that thing to come back down. And if they don't have the cash in their account, then they're going to get a margin call. They're going to be broke. That's why you always have to maintain excess cash in your account, because whenever you have an undefined risk trade, again, the buying power is dynamic, and as soon as the stock starts moving against you, you need more. So I really don't recommend earnings plays with an undefined risk to the upside. Downside you can manage, because you have this expectation of upward drift, etc., but not on the upside, not on stocks. ETFs, I'm okay with strangles. I do strangles on ETFs all the time. We'll do that in a future episode. But on stocks, this is a good setup, and let's see how it looks. All right, we'll follow this through the next week or so to see how it turned out. All right, that's 7 minutes. Thanks.